Welcome back to Smart Stock Sam, the channel where we do the deep work so you can make the smart moves. Today is May 20th, 2026, and we are having what could be the most important trading day of the year for NIO shareholders. I'm talking about a stock that has effectively doubled its business in 12 months, attracted the largest asset managers in the world, and built a technical chart pattern that only appears a handful of times in a stock's lifetime. But none of that matters if tomorrow's numbers fail to deliver on one specific metric. Before you touch this stock, before you add a single share, before you even glance at the ticker, you need to watch this entire video. We are breaking down the complete May 21st earnings playbook, the institutional footprints, the Wall Street battle lines, the exact chart levels to watch, and the one hidden number that will decide everything. Every layer of this story matters. Let's get into it. To understand where we're going, we need to plant our feet firmly in where we are standing right now. As of today's close, NIO is trading at $5.74. On the surface, that might look like a stock in distress. It dropped over 2% in the last session alone. But the headlines are not telling you the full story. Look at the actual business behind that price tag, and you find a company on pace for a staggering 109% year-over-year revenue growth. Think about that. While most companies are popping champagne for 10% growth, NIO is doubling its entire enterprise in 12 months. Yet the stock sits near its lows. That gap between a rapidly growing business and a declining stock price is precisely the kind of divergence that creates generational wealth for patient, informed investors. Our tactical stance is a cautious hold for current shareholders and a high-conviction buy signal for traders watching that $5.50 support floor. But there is a massive conditional attached to that view, and we will get to it in full detail. First, let's understand why the stock is where it is, because the answer is not what most people think. May has been a psychological roller coaster for NIO shareholders. It started with a genuine win. April deliveries came in above 29,300 units, a 22.8% jump compared to the same month last year. That should have been rocket fuel for a breakout. So why didn't it hold? Because the market immediately spotted something uncomfortable, a 17.3% sequential deceleration from March to April. In the world of high-growth electric vehicles, momentum is everything. Investors are not just asking where you are, they are asking where you were last month compared to where you are now. That March to April drop spooked the momentum crowd and triggered a wave of profit-taking. And then a regulatory shadow appeared. There is an ongoing probe into so-called battery locking, allegations that software updates have been quietly restricting electric range by up to 125 miles. Nothing is confirmed. No verdict has been issued. But in China's regulatory climate, even a whisper of government scrutiny is enough to send cautious investors toward the exits. This is not a fundamental collapse. It is a risk-off move ahead of a critical print. That distinction matters enormously for how we position around it. Here is where the story gets genuinely fascinating, and where most retail investors completely miss the plot. While the headlines paint a picture of chaos and uncertainty, the world's most sophisticated financial institutions are doing something entirely different. They are buying, not trimming, not waiting on the sidelines, buying aggressively. BlackRock, the largest asset manager on the planet, a firm that manages more money than most countries have in their entire economies, nearly doubled its stake in the first quarter, increasing its position by over 92% to nearly 11 million shares. Bank of America didn't just buy either. They doubled their stake to a record 14.2 million shares. Two Sigma is at record high holdings, and CYVN Holdings serves as a massive anchor, controlling nearly 18% of the entire company. Are there sellers on the other side? Yes. Jane Street and D.E. Shaw have trimmed, but the net flow of institutional capital points in one unmistakable direction. Elite, long-duration asset managers are showing deep conviction. They are not worried about 1 month's delivery dip. They are looking at the macro architecture NIO is building, the brands, the infrastructure, the supply chain, and planting their flags for the long term. When the smartest money in the world loads up like this, you sit up and pay very close attention. So if the institutional positioning is this bullish, why is Wall Street's analyst consensus still so divided? The current rating sits at a hold, but the spread of price targets tells you everything about the uncertainty underneath. On the bullish end, HSBC and Nomura carry buy ratings with targets as high as $6.80, pointing to the export ramp and new brand launches as underappreciated catalysts. Macquarie goes further with an outperform rating, but then you have the skeptics waving yellow flags with equal conviction. Deutsche Bank warns that the initial Envo L80 sales surge, which hit 10,000 units per month, will likely normalize down to 4,000 as domestic competition intensifies. That is a dramatic deceleration from current hype levels. Citi sits in the middle, appreciating the inventory management, but demanding visible evidence of real retail demand before getting more constructive. The tug-of-war between those who see a future technology giant and those who see a struggling automaker, that battle gets decided tomorrow morning. And the battlefield is a single line item buried deep in the income statement. Here is the cheat sheet for tomorrow. On revenue, the street expects a range between $3,550 million and $3,780 million. Hitting the top end puts NIO in the big leagues of global electric vehicle revenue. Here is the key context, though. NIO already pre-released its delivery count for the quarter at 83,465 vehicles, beating the upper end of its own guidance. That delivery beat gives us a high probability of a revenue beat as well, because revenue is largely a function of deliveries and average selling price. The market appears to have priced in disappointment, meaning an upside surprise could be genuinely powerful. On the per-share side, analysts expect the loss to narrow from 45 cents last year to somewhere between 22 and 24 cents. That is a massive step toward the break-even threshold the market has been demanding. But I want to be direct. Revenue is not the number that moves this stock tomorrow. Deliveries are not the number. There is one metric that decides whether this is a rocket or a crater. Listen carefully, because this is the most important point I will make in this entire video. The vehicle gross margin is the only number that matters tomorrow, not revenue, not total deliveries, not forward guidance, the gross margin. Citi is projecting 17.9%, the absolute floor the market needs to see to keep the profitability pivot thesis alive is 15%. If NIO can hold above that line in what is historically a weak first quarter, the story shifts fundamentally. It proves they can extract more value per vehicle even as volumes fluctuate. The risk is real. Sequential volume declines compress margins because fixed costs spread across fewer units. But NIO has a buffer. They have been executing aggressive cost discipline across manufacturing, and their sales mix is migrating toward higher margin vehicles like the ES8. If management can show the world they are making more money on fewer cars, the growth at all costs era is officially over. The era of sustainable, durable profitability has begun. That is the inflection the institutions are betting on. That is the number that either validates or destroys the entire thesis before the market opens for a second session. Now, let's look at the battle map, the technical chart. In the short term, the picture looks challenged. NIO is trading below its 20-day and 50-day moving averages, a textbook bearish configuration. The relative strength index sits between 34 and 42, approaching oversold territory, but not yet at that capitulation point where violent snapback bounces typically ignite. However, when you zoom to the long-term frame, everything changes. We are comfortably above the 100-day and 200-day moving averages, and back in April, NIO triggered a golden cross, the 50-day average crossing above the 200-day. That signal has historically preceded sustained upward trends. The current pullback is not a breakdown. It is something specific and something important. Look at the structure forming on the daily chart. The recovery rally from March through the April highs carved out a beautiful cup, a smooth curved accumulation base that signals institutional buying. What is happening right now, this pre-earnings compression, is the handle. And the handle is not a problem. The handle is where weak hands get shaken out, where impatient traders surrender their shares, so that when the real move arrives, there is no overhead resistance left to absorb it. The breakout target zone, if NIO clears $6 with volume, stretches from $7 all the way to $10 per share. That is a 74% potential move from current levels. But the breakout is entirely conditional on tomorrow's earnings catalyst, providing the volume needed to punch through that $6 ceiling. Without that volume, the handle breaks, the pattern fails, and we revisit the $5 area instead. The catalyst is everything. And here is the explosive element that nobody is discussing loudly enough. NIO currently carries over 134 million shares sold short. The short interest ratio stands at 4.37 days to cover, meaning if NIO delivers a beat and raise tomorrow, short sellers would need over 4 full trading days at average volume just to buy back their positions. That is a textbook setup for a short squeeze, where forced buying from trapped shorts compounds upward momentum from long buyers and creates moves that feel almost violent in their speed. Look at the options chain for May 22nd. Over 81% of open contracts are calls, with traders positioned heavily for upside, and implied volatility sits at 111%. The market is pricing in a significant directional move. It does not know which way yet, but it knows something is coming. The question is whether you are positioned for it. Here are the exact levels for the next 48 hours. The entry zone is $5.60 to $5.75. Roughly where the stock trades today. A post-earnings confirmation close above $5.80 is the green light. Your line in the sand for risk is $5.50. A close below that level breaks the near-term thesis, and the next technical floor drops to $5 flat. Do not fight the tape below $5.50. To the upside, the primary target is the analyst consensus zone between $6.60 and $6.80, where April highs sit and where first-wave profit-taking is expected. Clear that zone on volume, and the upside extension target becomes $7.13, the upper rim of the cup pattern. Defined risk, defined reward, defined levels for a defined window. But step back from the 48-hour trade for a moment, because NIO is building something much bigger. It is a 3-brand ecosystem repositioning itself as a dominant force in global mobility. At the premium end, the NIO brand drives high-margin revenue and aspirational brand positioning that commands loyalty. In the middle, Onvo targets the mass market and competes directly with the most popular Tesla models, bringing technology-forward vehicles to a demographic that was previously priced out. At the entry level, Firefly, which the chief executive has compared to the iPhone in terms of emotional resonance and lifestyle identity, is designed to capture global demographic reach that no other Chinese electric vehicle brand has ever seriously attempted at scale. Think about that ambition for a second. This is not a company playing defense. This is a company designing an entire market hierarchy from the ground up. By building this tiered ecosystem, NIO insulates itself from slowdowns in any single segment. A softness in premium does not kill Onvo. A Firefly stumble does not slow the NIO flagship. This is not a luxury niche play anymore. It is the architecture of a mass-market empire, and it is being assembled in real time, and backing that empire is an infrastructure moat that most analysts still dramatically underestimate. Over 5,000 proprietary charging assets have already been deployed across the network. Fifth-generation power swap stations are being actively tested, and this battery swap technology, the ability to physically replace a depleted battery with a fully charged one in under 5 minutes, is NIO's definitive answer to range anxiety, and it is an answer no competitor has been able to replicate at meaningful scale. On top of that, NIO is developing its own silicon through the Shenji NX9031 chip program, reducing dependency on third-party suppliers and securing long-term cost advantages that compound over time. The ES9 launches May 27th. just 1 week away. The Onvo L80 delivery ramp is accelerating. The pipeline is full, and the infrastructure to support that scale is being built aggressively right now. Before I give you the final verdict, I have to pause for something important. Everything in this video is for educational and informational purposes only. Nothing here constitutes personalized financial advice. I am not a licensed investment professional. All investing carries risk, including the potential loss of your entire principal. Earnings events are unpredictable. Chart patterns do not guarantee outcomes, and the electric vehicle sector is particularly volatile. Regulatory risks in international markets are real and can materialize without warning. Please conduct your own thorough due diligence, consult a qualified financial advisor before making any investment decision, and never commit capital you cannot afford to lose entirely. Invest responsibly and with full awareness of the risks involved. Here is the bottom line. For current shareholders, this is a hold. The institutional positioning, the delivery trajectory, and the technical structure all point to a firm floor. Do not let pre-earnings anxiety shake you out of a position that the smartest capital allocators in the world are actively reinforcing. For tactical traders seeking a new entry, NIO is a buy in this 560 to 575 zone with a hard stop at 550 and your eyes fixed on that $6 breakout. The entire thesis, near-term and long-term, rides on one number, a vehicle gross margin above 15% tomorrow morning. If they deliver it, the profitability pivot is confirmed and the recovery toward the $7 breakout zone begins. If they miss, manage your risk, wait patiently, and let the next setup form on your terms. Now, here is my genuine question for the comments, and I want you to think hard before you answer. If NIO beats on gross margin tomorrow but misses on revenue, does the stock go up or down? Your answer reveals something deep about how this market actually values NIO right now, and I want to see the debate play out below. Drop your take in the comments. I read every single one. If this breakdown brought you clarity heading into tomorrow's print, hit the like button. It genuinely helps Smart Stock Sam reach more investors who need this kind of analysis before they make high-stakes decisions. Subscribe so you never miss a real-time earnings playbook like this one. And if this video saved you from a costly mistake or helped you spot an opportunity, consider sending a super thanks through YouTube's built-in support feature. Every contribution goes directly toward more research, more deep dives, and more content that actually moves the needle for this community. I will be back with a full post-earnings reaction and updated trade levels the moment the numbers drop. Until then, watch those $5.50 and $6 levels like a hawk. Manage your risk with discipline. And I will see you on the other side of the earnings.